Hello there. Welcome to Trading Day. I'm Andrew Bell. Let's get to the big stories we're bringing you from our newsroom. Canada has reached a new trade deal with China. The Prime Minister, Mr. Carney, says Canadian tariffs on some Chinese electric vehicles will be eased in exchange for reduced levies on canola exports and other Canadian farm goods. The announcement comes after Carney met with the Chinese President Xi Jinping, looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
Ontario's Premier is condemning that agreement to allow up to 49,000 Chinese EVs into Canada yearly at a levy of just over 6%. He says this gives Beijing a foothold in the Canadian market at the expense of Canadian workers. The Ontario leader has said Ottawa is inviting a flood of cheap, made-in-China EVs without any real guarantee of equal or immediate investments in the economy, the auto sector, or supply chains. WestJet is going back to its old seating configuration after the company reviewed guest feedback on its so-called densified seating. The company said it will remove one row of seats in the aircraft that were affected, bringing back previous legroom in economy cabins. The airline's CEO says the company will take what it has learned from this situation and continue to be cost-disciplined and innovative. TSX trading in record territory once again today. Let's have a look at the U.S. markets. They are... Well, there's the S&P up, still not quite in record at record level, but holding its own today. Well, let's get a reaction from south of the border to this preliminary trade agreement between Canada and the U.S. The sides agreeing to ratchet back tariffs on EVs on Canada's side, and the Chinese agreeing to reduce levies on Canadian agricultural exports. We are joined by Sam Stovall, Chief Investment Strategist at CFRA. Sam, it's great to have you here to give us a U.S. perspective. I don't think we've seen reaction from the White House here, but Canada's certainly breaking with the Americans to some extent on bringing in the EVs at a levy of just over 6%.
Well, that's right, Andrew. And I think you brought up an interesting point, that concern in Canada that just the cars will be allowed to come in rather than plants being constructed within Canada. When President Trump was talking to the United Auto Workers in Detroit recently, he was asked a question about opening a foothold to the Chinese EVs in the U.S. And he said, well, so long as they're willing to build plants, hire American workers, then he said he's open to it. So I think we'll have to wait to see what actually transpires.
Yeah, we've heard from participants in the auto parts industry here in the past that the Chinese have not been receptive to opening factories here in Canada. But of course, we can assume talks are going on to try to bring them in. It will be frustrating, though, I suppose, for the White House, the administration, if Canada isn't presenting a united front to China on this issue.
Well, that's true. Certainly, the U.S. is trying to create its own buffer by acquiring Greenland and keeping China and Russia at bay, when actually what we could find out is that the Chinese are right at the 49th parallel. So we'll see what actually transpires.
But you think it's understandable that Ottawa has had a hard time on trade from the Trump administration. Mr. Trump the other day said, we don't need cars made in Canada. So you think it's perhaps not entirely surprising Mr. Carney would seek a deal with Beijing here?
No, it's not. I think that the Canadians and Americans have traded very well together over these many decades, and so to end up having your primary trade partner then decide that the relationship doesn't work and that it's over causes one to not be surprised that they then turn to their second largest trade partner, which is China, and so it is a disappointment, certainly, I think, on both sides of the border.
Let's turn to the markets. Intel is on your radar right now. What are the implications, possibly, of Taiwan Semi, the global giant, rapidly increasing its capital spending?
Well, Intel, which we have ranked hold at this point, certainly is not the leadership company that it was back in the 2000 era. And now with Taiwan Semi looking to build factories in the U.S. to establish its own foundry business, that is a negative for Intel, in our opinion, because now it has to compete with Taiwan Semiconductors here in the U.S. For companies that are looking to buy chips.
Yeah, it's interesting. Intel, of course, just remind us, I mean, do they have any kind of strength in AI devices?
Just minor things, but working in that direction. They did indicate recently that their Core Ultra Series 3 processors are making their first AI PC platform built in the U.S. And so, in a sense, they are making some minor steps into that area.
The January so far, pretty good for the markets, and that tends to be historically a good omen for the full year.
Oh, it absolutely does. Every year going back to World War II, on average, the S&P gained 9.3% and was higher 72% of the time. However, whenever we started the year with a positive January, the S&P gained more than 16% and was higher 86% of the time. So obviously not a guarantee, but a fairly positive way to start the year. What is, or at least has been a guarantee, is if the first quarter low did not undercut the prior December low, then the S&P was higher for the full year 100% of the time.
But midterm election years can be choppy and unpredictable?
I think that's an understatement, Andrew. It is by far the worst performing year in terms of average annual performance, up only 3.8% since World War II, rising just 55% of the time. So really no better than a coin toss. And the average annual drawdown is the highest at 18%. So fasten your safety belts.
The meteoric rise in gold, is that in some ways an ominous sign that people are worried about possible debasement of the U.S. currency, for example?
I think it's a combination of concerns about just geopolitical tensions and central bankers because of the tariff situation saying, maybe we're better off holding gold than we are holding U.S. treasuries. Also, with the value of the dollar coming down, and since gold is priced in dollars, then that makes it more affordable to overseas investors. And it is a store of value. So a place where investors can put their money if they are very uncertain about the future.
Sam, I think we better jump. Thank you very much indeed for joining us.
Always good to talk to you.
Sam Stovall, Chief Investment Strategist at CFRA. Up next, we're going to bring you this week's Bloomberg Doc, exploring how consumers and businesses are navigating changes in the Japanese economy. Stick with us. For 30 years, Japan's prices were largely at a standstill. But now a weak yen has changed everything. Bloomberg Originals takes a look at how consumers and businesses are coping with rising costs and what that means for the future.
In 2016, this Japanese company issued a public apology. For the first time in 25 years, they were hiking the price of a popular ice cream by 10 yen, or about 6 cents. And they were deeply sorry. Now, in any other country, this might have been an overreaction. But in Japan,
inflation is just completely alien as a concept.
for 3 decades, the country saw stagnant or even decreasing prices, which is why a 10-yen price hike for an ice cream was such a big deal. But a huge slide in the yen is helping change that picture. And it's causing a seismic shift in Japan's economy. The yen has weakened against the dollar to a level not seen since the early 90s.
The weaker yen means higher prices for all sorts of imported goods, from groceries to gasoline.
It's also making it pretty attractive for inbound tourists looking for a cheap vacation. Steering the country through this once-in-a-generation cost of living crisis is the inaugural challenge for Japan's new leader.
Tsunai Takaishi has been voted in as Japan's first female prime minister.
Japan has arrived at that big moment where there's a potential transformation of the entire society.
So how did Japan get to this point? And can it learn to live with rising prices? This unassuming grain has become emblematic of one of Japan's biggest challenges.
It's very much sort of entrenched in the Japanese psyche that if you go to the supermarket, eggs are going to be a certain price or rice is going to be a certain price.
You can see that here. For years, the price of rice in Japan barely changed, and sometimes it even dropped, but not anymore. The price of rice has surged since 2023, and the problem extends beyond what's on the dinner table. Prices for energy, transportation, and housing have all been on the rise.
If you live in the US or the UK, seeing prices rise is not as foreign a concept as it is in Japan.
This has been a terrible shock. We have a whole generation of people who've never seen prices go up. What is going on?
Well, to answer that, you've got to rewind to the 1980s.
After 2 decades of rocketing expansion, the Japanese now enjoy the highest standard of living in Asia.
Japan's economy was expected to overtake America's. But around the late 80s, there was a bubble in asset markets, and this burst. Asset prices plummeted, stocks plummeted, property prices fell for more than a decade.
Deflation, layered on top of rising debt and an aging population, created a drag that suppressed Japan's growth for years.
Deflation is one of the biggest threats to Japan's economic recovery.
The exit strategy was to stimulate inflation through extreme monetary policy. The Bank of Japan, or BOJ, held interest rates at rock bottom for decades, even driving them negative. It also bought huge amounts of government debt that helped pour money into financial markets. Both factors helped weaken the yen sharply. But it didn't move the needle enough. Salaries stayed put, mortgages never budged, and price tags remained frozen. 2 massive forces broke the cycle. The first in 2020, when the world went into lockdown, triggering a global economic shockwave.
And then there was the Ukraine war. There was a big impact from that as well.
For a country like Japan that imports most of its energy, you're going to literally import inflation.
Prices started rising and inflation became sort of a thing.
Even so, Japan continued to keep interest rates at rock bottom levels, accelerating falls in the yen and fueling yet more inflation. In 2023, it exceeded 4%, double the BOJ's 2% target. It was time to do something, and finally, Japan put an end to that massive money experiment.
The Bank of Japan hikes interest rates for the first time since 2007 and scraps yield curve control.
All that pent-up spending that didn't happen during the pandemic now comes in a big wave.
So much so that in early 2025, Japan's inflation rate was the highest among G7 countries. And this has pushed companies great and small to reevaluate their business plans.
この辺のものも全て、軒並み2割ぐらいは以前と比べて上がっている状況ですね。今回の物価高の波で影響があったものというのが非常にやはり大きくて、いろいろ電気代とかそういうものも上がって。
Costs have also increased for packaging and other materials.
ですけども、現実お客様にそれだけの負担をどんどんかけることによって、購買意欲ってすごく落ちちゃうんで。
As prices have risen, slow wage growth has become a major concern.
I've talked to some, small business owners, and they want to raise wages, but being forced to do that has actually added a lot of pressure for them as well.
1000円台超える前ぐらいからうちもう結構1200円台で時給取ってたんですけど。
Minimum wage has caught up or even surpassed that, depending on the prefecture. So Masashi Miwa is faced with paying as much as 1,500 yen per hour to attract quality staff.
きついですね。はい。
While minimum wages have risen, they haven't kept up with prices. You can see that here. Wages adjusted for inflation, also known as real wages, have actually been in decline.
This is why the ruling Liberal Democratic Party hasn't done as well in the past couple of elections.
We'll come back to what this means for the new prime minister shortly. But first, there's something worth remembering.
Japan wants inflation. Policymakers in Japan have been trying to generate inflation for over a decade.
The problem is that it doesn't want too much, or for it to rise too quickly.
An appropriate amount turns into a virtuous cycle. Prices rise, people seek higher wages, people kind of consume and spend more.
But that cycle hasn't arrived yet, and Prime Minister Takaichi needs to maintain stability while society and the economy adjust.
Policymakers have been trying to sustain the patience of the consumers and the voters by giving them subsidies to keep the edge off the cost of living crunch for the basics.
These are kind of countermeasures that have wide-ranging impacts on not just the economy, but also fiscal spending, revenue, government revenue.
Because these subsidies don't come for free. They're funded through borrowing at a time when public debt is already off the charts.
Japan has the biggest national debt load of any advanced nation, over 200% of GDP.
Pushing interest rates higher could help cool inflation, and the BOJ did just that.
The Bank of Japan raising its benchmark interest rate to the highest in 30 years.
Problem is,
it's going to make servicing that national debt more and more expensive. The pace at which the Bank of Japan raises interest rates has key significance for the yen. So for currency traders, companies doing businesses, exporters, importers.
So it's tricky to say the least, and Japan brings other unique complications to the table.
Japan has an aging society. They're reliant on pension incomes that are not substantial enough to sustain them through after-retirement life.
日本って何だったっけ、その物価スライド制っていう物価が上がるほど年金は上がらないよっていう仕組みを取っているので、やっぱり自助努力っていうか自分である程度貯金運用はしとかないといけないなというのをやっぱりこの物価が上がることによって結構ひしひしと感じ始めたかな。
We've seen a large movement of money from savings into stocks. And this has been facilitated by government policy, enabling people to open accounts where they get beneficial tax breaks.
You can see this shift in the stock market. In 2025, the Nikkei, an index of Japan's biggest companies, hit a record high.
If growth can be restored, this means these companies are going to be worth investing in.
The mindset of the ordinary person in the street is that inflation is a thing, They have to adjust their lives to it, and Japan is probably not going back to deflationary, stagnant prices anytime soon.
So the key question for Japan's inflation story is, can the economy recreate the innovation and the vibrancy it saw in the late 1980s?
Or is it risking the stability and security it's had for a future in which households can't keep up with prices and we see growing inequality?
Yeah, biggest debt load in the developed world. A lot of problems facing Japan, plus the rough demographics, incredibly low birth rate in all those wealthy Asian economies, Taiwan, Singapore, and Japan among them, and South Korea. Coming up, we are continuing our coverage of oil. Crude up around 1% this week amid questions over the future of Iran. Let's have a 1 week chart of oil if we can. Just check how crude in North America has fared this week. As of today, it was up something like 1%. So not a massive move, but yeah, you can see up 1% in the past week. There was a spike, though, earlier amid fears, among other things, that the Americans might launch an attack on Iran after the killing of unknown numbers of protesters. Let's get more from Rob Thummel, Senior Portfolio Manager and Managing Director at Tortoise Capital. Thanks very much indeed for joining us. It's interesting that we have two geopolitical stories, Venezuela and Iran, on the boil.
No, you're right, Andrew. It's there are two, but yet there is probably zero geopolitical risk embedded in the crude oil price at the present time. So that, from our perspective, offers the potential for crude oil prices to rise just because of these added geopolitical concerns that seem to be rising, coming up every day.
That's interesting. So we've heard that for quite a while now, that the oil market seems remarkably calm about geopolitical risk. You don't even think that a bit of risk premium is edging into crude right now?
Maybe a mild amount, but not a lot. And if you think about what's going to happen, I mean, so it's all about geography, right? With Iran, and it's the Strait of Hormuz, right? And where Iran is geographically relative to the Strait. And as a lot of your viewers know, the Strait of Hormuz is very, very important. It's very critical in the transportation of energy products globally, right? But especially oil, because tens of millions of barrels a day go through that strait. And so if Iran would somehow, some way temporarily block that strait, that would cause really wreak havoc on the global oil market and reduce the supply, at least on a temporary basis. Now, obviously, there's a lot of interested parties, including the U.S. and China and others, that want to make sure that doesn't happen. But the reality is that the Strait of Hormuz is a really important point and a really important strait for the transportation of a lot of energy commodities around the world.
Yeah, I've heard it said this week that that would be a desperate move for the regime in Tehran, maybe one it would do if it really felt its back was to the wall.
Yeah, I think it is a last-ditch effort, but absolutely. But it would cause oil prices to rise substantially. So the more realistic view is as you highlighted from the start, is will we add even more geopolitical risk to the oil price? And I think you could see the oil price rise a few more dollars from here as these tensions continue to rise. Now, if somehow we were able to everything was able to calm, then the fundamentals are still the same, and they frankly still are, even without geopolitical risk. The fundamentals in the oil markets are still the same. The global oil market is oversupplied, and so that's why the oil price came down last year. And so until we get an adjustment in supply or higher demand, then we're probably just going to be seeing an oil price move with perceived geopolitical risk.
Where do you see oil going in the next year, Rob? I know that's an impossible question virtually to answer with so many factors, so many variables and wild cards. But do you see crude edging up despite fears of a glut?
We do, Andrew. I think what we'll see, and maybe it's over the next year is actually probably a good time frame to talk about. We look at it at Tortoise from an energy perspective as kind of energy experts per se over a much longer period of time.
Mm-hmm.
But what I would say is, yes, oil prices probably inch up. I mean, because we do think that you'll see less oil production, especially in the U.S. And so that will reduce the oversupply. Actually, I think from a consumer perspective, we'll actually probably see better demand than what we expect because of the lower oil price, both domestically and globally. So that'll help as well as balance the global oil markets. But longer term, the kind of the Goldilocks price scenario for producers and consumers is probably in the 70s, the low 70s range. And we think we get there over the longer term. We're not probably going to get there this year, and we'll probably still be in the 60s. But over the long term, we think we could see the oil price move up, in the low 70s at some point in time.
Interesting deal. I see Mitsubishi, the giant Japanese trading company, spending more than $5 billion to buy into U.S. shale natural gas.
Well, that shows you what people think of natural gas, right? And I think Andrew, you and I have talked before.
Mm-hmm.
At Tortoise, we are big fans of natural gas, not just in the U.S. but Canada as well, because of what's happening with AI, right? And as you know, we think electricity is going to become the new oil. Natural gas and nuclear are going to be the primary fuel supply sources. One of the reasons why the U.S. can win this global AI race is because we have low-cost electricity in here, because we have low-cost natural gas from the U.S. and, fortunately, from Canada as well. And so so we think that natural gas is actually a great place to be. We think natural gas demand is going to rise and grow steadily for not just a few years, but for likely decades. And so we are big fans of the opportunities in natural gas, all the way from the producer to the pipeline companies that operate the pipelines that transport it, all the way to the electric users that are generating power primarily from natural gas.
Rob, we better leave it there. Thank you very much indeed for joining us.
Thanks for having me.
Rob Thummel, Senior Portfolio Manager and Managing Director at Tortoise Capital. Coming up, the Prime Minister says Beijing will cut tariffs on Canadian canola down in some cases to about 15% from more than 80%. We're going to hear from Rick White, CEO and President of the Canadian Canola Growers Association. Okay, the Prime Minister is expecting that tariffs on Canadian canola will edge down in some cases to about 15%. These are tariffs imposed by China in return for Canada letting in about 49,000 electric vehicles from China each year with a tariff of just over 6%. Let's get more from the canola industry. We're joined by Rick White, CEO and President of the Canadian Canola Growers Association. Rick, thanks very much indeed for joining us. Now, I know as of this morning you are still seeking details. There's different types of canola. Of course, there's the seed, the meal, the oil. Can you give us any kind of breakdown on what stuff you are getting lower tariffs on?
Right. I'll start with seed, Andrew. That's by far the biggest component of the trade that we do with China. And on the seed itself, it looks like the deal is going to be that the tariffs on canola seed going into China will be dropped from the current levels of almost 76% down to 15%. So that's a significant drop and opening up the opportunity to get back into that market on the seed side. And, typically we put about close to 6 million tons of canola into that market. It's worth about $4 billion. Very, very important. So that is good news. On the meal side, another significant contributor, I guess, to the canola shipments into China, and the canola meal tariff that was currently in place. That was a 100% tariff rate on canola meal as a result of anti-discriminatory investigation. So that has been zeroed out starting March 1, at least until the end of the year. So that is good news. On canola oil, nothing has changed in that area, but it's by far the smallest chunk. I'm not dismissing its importance, but the two big ones were seed and meal, and we've got some good news on that one.
And the canola meal often used as a livestock and poultry feed.
Right. Yeah, that's what it's used for around the world is protein, and it makes excellent source of protein, especially in dairy cows. So it is required, and China has heavy demand for proteins like canola meal and other meals of oilseed products like soybeans.
I know you don't want to be getting into any kind of a shouting match with the Premier of Ontario, and you wish automakers well in Canada, but what would you feel if somebody said to you, well, yeah, but there's an opportunity cost here. We're going to be letting Chinese cheap EVs in here.
Right. Well, we were the subject of that decision to begin with, the political decision to do what triggered all of this. And at the end of the day, we are focused solely on what we needed and what our farmers needed to get canola trade back with our second largest export market, which is China. What it took to get there was political decisions. What got us here were political decisions historically, and it needed political decisions to get this resolved. So those decisions on what the trade-offs were to get this are the responsibility of the politicians and Prime Minister Mark Carney specifically. He made the call, but we are very, very supportive and very thankful to the group of the delegation that went over there, that politically went over there, because that's what it took to get this done. So to others, I would say canola is a major contributing factor to the Western Canadian economy and farmers in particular. There are other ways to deal with other parts of the economy, and the Prime Minister has made a decision on that.
Can you give me an idea now? I believe our canola exports in 2024 were something like $15 billion altogether to all markets. What kind of a drop-off did you see last year with China imposing those measures?
Yeah, the futures price certainly weighed heavy on the futures prices, and that's not the only problem, though, Andrew, because what farmers actually receive is a deduction from the futures price called the basis, and the basis levels had spread out even more than the futures had collapsed. So at the end of the day, what happened was there was significant value deterioration of the canola that was grown by farmers due to none of the factors that they normally would manage with normal markets and weather, et cetera, pure geopolitical risk here. And that's what happened. And that was what what created the deterioration in the value. And that was the problem, that farmers had all this production. It's in their bins right now, and the values were tumbling. And this deal will get those things back on track if we see canola actually being exported to China as a result. There's still tariff in there, but we are very hopeful and optimistic to some degree that the success of this will be determined by the movement of canola, the sales of canola going back into China. So the value recovery can start now if the demand is open up enough now that we can get this product over there, and over time it'll even itself out.
Just remind me, how many millions of tons of product altogether would Canada hope to sell to China in a regular year?
Well, typically, like we've been up on the seed market close to 6 million metric tons. That was about $4 billion, and that was the latest full year that we had.
Yes,
and that's a lot of product. It's it's very valuable. It's a significant part of our production, which is typically around 21 million tons of canola seed in this country. Almost 6 million tons of it went to China in the form of seeds. So it's very, very important to us. And the U.S. market is our number one export for canola products as well. So we can't have problems with our two major export markets without having a substantial negative impact on the livelihoods of Western Canadian farmers.
I'm sorry, just remind me, in the States, have we had tariff problems with our canola sales into the States?
No, we haven't. It's moving in under it's Kuzma compliant, sure. And there's no tariffs in place. That's more of a an oil market for our canola here in Canada. So it's crushed here, shipped across as oil, and trade resumes. It's very, very important that we keep that market open because that is our #1 export destination for Canadian canola.
Rick, thank you very much indeed.
Thank you, Andrew.
Rick White, CEO and President of the Canadian Canola Growers Association. Stick around. Bloomberg's Canadian finance reporter Christine Dobby is here with the latest from Bay Street. She's up after the break. Time to check in with Bloomberg's Canadian finance reporter Christine Dobby, who writes the Bay Street Edition, a weekly newsletter covering all the latest news in Canadian finance. Christine, I know how, generally when people ask me how I am, I sigh bravely. That's what I do all year. I don't want to burden people with my troubles, but everybody's feeling that January sigh right now.
Absolutely.
Obviously, the days are getting longer, but the weather's miserable. And you think this pessimism translates perhaps excessively into how people feel about their finances? Consumer confidence is low. A lot of people, maybe 40% or more, feel their finances have deteriorated in the past year. But the economy broadly is not that bad.
Yeah, obviously it's not clear if this is specifically related to it being January.
Yes.
Maybe that's just myself. But yes, the recent polling of Canadians suggests there's not a lot of confidence about the state of their own personal finances or where the economy is heading. And that is despite some indicators that would suggest we're not doing that badly. The country avoided a recession last year. It looks like GDP for the whole year is going to come in around 1.7%, which isn't, it's below long-term averages, but it's not a wipeout that we might have feared given what we went through last year. And also there's been a reversal in the trend on income growth and cost of living. In 2023, actually, CPI started heading down, that's inflation, started heading down, and wage growth has been trending upwards since then. So there are reasons that we should be maybe feeling a bit better than we are. But as I highlight in the newsletter this week, RBC's Francis Donald, who's the chief economist there, talks about how a lot of those numbers are averages. And so, as you might expect, people in the top end are doing quite well. They've seen huge gains in their stock portfolios over the past year. Their real estate wealth is only increasing. And those in the lower end, they spend a lot of their money on food and shelter, and those costs have gone up by about 1/3 since the pandemic. So some people are really feeling the pain a lot more than others.
It's interesting. Yeah, as you say, Bloomberg's Nanos Canadian Confidence Index, pretty well, it's barely in positive territory, so people are feeling gloomy. It really is incredible, this income divergence, perhaps even more marked in the States, just 10% of U.S. households accounting for a vast chunk of the American economy, let alone growth right now.
Absolutely, and we're hearing more and more about this. You'll hear the term K-shaped economy or K-shaped recovery, and Frances Donald herself did say that it's even more pronounced in the United States, as you say. This is why affordability has become such a hot topic in the United States with the midterm elections coming up. Trump's, trying to walk this line between imposing tariffs that increase the cost for many Americans and also appealing to people from a more populist level. You saw him last week vowing to cap credit card rates at 10%, which is much lower than they currently are. Very populist move, and not exactly the deregulation that many in the banking industry had hoped for. And a lot of this ties back to this income inequality and the concern about affordability. Whether some people might just be feeling poorer than they were a few years ago, but some people actually are really struggling to meet those day-to-day costs.
Christine, I have to, you're trying a sunlight lamp, are you, in the mornings just to get the day going? And so far the jury out?
I think it helps. It's hard to tell.
Yeah.
I feel good right now.
Good.
It is nice to have a little bit of bright light in the morning because it's so dark in the morning.
Oh, you're telling me. Yeah, I know you hear health bloggers say,
Yeah.
get sunlight in the morning as soon as you can, but there ain't no
Right.
sunlight. Yeah.
How can you do that if there isn't any?
Christine,
Yeah.
thank you very much indeed. Christine Dobby of Bloomberg.
Thanks.
And remember, she produces that newsletter, Bay Street Edition. You can get to it at bloomberg.com/newsletters. Up next, more coverage of the Prime Minister's trip to China and reaction to that trade agreement, trade outline pact that he reached with the Chinese. We'll hear from our own Lindsay Biscaya. Let's get more on Mr. Carney's progress in China on trade. Lindsay Biscaya joins us now. I do remember there were quite a lot of cautions. Oh, don't expect anything quickly, but it has got some kind of a deal.
A lot of people were saying this is just going to be a talk. This is going to be a warming of those relations, but it seems as though it's much more than that, considering what we're hearing today. So this coming out of Beijing today, Prime Minister Mark Carney announcing that new kind of trade deal. So now China dropping tariffs on canola seed to 15% from Canada. And canola meal, lobsters, crab, peas, those will no longer be tariff coming in from Canada. This is supposed to all start March 1st and last until the end of this year. And that's something Scotiabank kind of picked up on today in their analysis of this, is that there's still some uncertainty in terms of what happens at the end of this year. Not clear why that is, but it's just something to keep an eye on. And there's also no mention of tariffs on canola oil coming in from Canada to China. In return, though, and this is the big news we're hearing this afternoon, of course, Canada allowing those 49,000 Chinese electric vehicles into the market each year at a tariff rate of 6.1% instead of 100%. And we're getting some strong words this afternoon from Ontario Premier Doug Ford, who, of course, didn't want this to happen. He wanted Canada to keep that 100% tariff on electric vehicles coming in from China. And he spoke to reporters earlier today. Here's what he had to say.
We're letting China into a market that's going to have lower tariffs than our largest market, the U.S., and I don't think that's going to go over too well with President Trump. But it's going to hurt every single auto manufacturer, every single supply chain that has anything to do with the auto sector. This was not thought out properly. It wasn't consulted. It was a knee-jerk reaction as far as I'm concerned. And this is going to be a big, big problem.
Doug Ford, when he's speaking to reporters, also trying to coin the term spy cars. He says he doesn't trust Chinese-made electric vehicles in terms of the technology within them. And you heard him talking about Donald Trump there, saying he doesn't think this is going to fly by Donald Trump. But we have heard from Donald Trump actually today. And he said that basically okaying the deal, saying it's fine. But we also have heard from the U.S. Trade Representative, Jamieson Greer, saying this decision is problematic and that Canada might regret its decision. So mixed words coming out of the White House.
Yeah, it might have been just an off-the-cuff thing by President Trump. Yeah, saying, if you can get a deal with China, you should do that. And that's what Carney should be doing. But Trump may, of course, he may not have been fully briefed or something.
He might not have been fully briefed. He was mostly talking about other things. When he was speaking with reporters outside the White House, he also might change his mind in terms of what he thinks when he has time to sit down and look at the actual stuff coming out of this. But just in response to what Doug Ford had to say today about Chinese electric vehicles flooding the market, Carney is saying that what you're allowing in terms of the number of vehicles is about the same as what we used to allow in from China back in 2023.
And it's only about 3% or something.
It's only 3%. That's what he's saying. And you mentioned earlier, right, when you look at the number of vehicles that are sold in Canada, 1.9 million vehicles a year, roughly. So there's some back and forth that we're seeing right now, but it's very interesting developments coming out of China.
For sure. Lindsay, thanks very much indeed. We are out of time on trading day. Thank you very much for watching. Have a wonderful weekend.